Welcome to today's Conquer Risk podcast. Manish, how you doing today, bud?
Good. How are you?
Not too shabby. It's always good to come together, and I find it interesting, right? We always end up in the same scenario where we come up with topics because you and I are having conversations. It's what's going on in the marketplace, what conferences are going on or that we have attended, or in this case, what a lot of both media as well as questions by advisors are coming in. And it stems around the fact that the markets have been pretty crazy. Obviously, S&P 500, as an example, dropped a whole bunch the last month, and it's taken off in a tear, right? So the question has been why, when we see different companies coming out with crappy earnings, because they haven't been able to do any business, and our economy's been shut down, why is it that things like the S&P take off like a rocket ship? What are your initial thoughts, bud?
Yeah, I mean, it sort of comes down to, how it's constructed. And so, when you look at the underlying components across the market, things like energy, obviously, right? Banking, leisure, transports, these things are all down, 20, 30, 40% in some cases, with the S&P down, I don't know, 8 or 9 as of I guess the end of April or the 29th of April. And so, the answer is really, market cap weighted index, which is what the S&P 500 is. And that sort of skews everything. So even if you own a collection of stocks and your stocks are doing worse than the overall S&P, there's a mathematical reason why, and it comes down to sort of how it's constructed.
Well, that's why we have kind of joked about the rich getting richer. Whether it be this process of index investing, which over the last 10 years is obviously it too has taken off like a rocket ship. The scenario is that, I mean, there's a handful of stocks that are really driving a lot of what I think not only individual clients but even advisors perceive, or wrong or right, that the market is actually doing great. Funny enough, the first headline I looked at this morning is the market's down because of crummy earnings. I'm like, what the hell? The country's been shut down. How many companies do you think are going to be doing great? But anyway, so let's start with this. I mean, let's dive in a little bit. What is the market cap indexing, just to make sure that everybody's on the same page?
Well, I mean, some of it's self-explanatory, I would hope, for most advisors, where a market cap is basically the price of the share times the shares outstanding, right? You're looking at the total capitalization of the company, and then the index is constructed based on that. So obviously, the larger companies are going to have a larger share of the index versus a price-weighted index like the Dow, where it has nothing to do with the shares outstanding. You're just looking at the price of the actual stock. So market cap-weighted index, S&P 500 is the most recognized. One of the ones that we like and that follow, or Russell 3000 is another one, and obviously the most famous price weighted is the Dow. They have other things like value weighted and things like that, equal weighted, but what's reported on the screen is either price or market weight. When the media reports the stock market.
Yeah, I was looking at did a little research, right? And equal weighting came out in 2003. Which is kind of humorous because for the most part, again, it's been this last 10 years, it's been a massive group of, I shouldn't say a massive group, a small group of big stocks that have really taken off and driven the ship. Do you think this really matters in the scheme of things? I mean, is it mostly academic, or is it something that really both investors and advisors should pay attention to?
Yeah, no, I think it matters tremendously. I'm not sure it's academic at all, because there's a lot of products now that track indices, and there's a lot of assets flowing into that. And so it just comes down to understanding, how those products work. A completely, unrelated and side note here is things like the oil ETFs, where, people think they're tracking the price of oil, which is generally impossible to do on a day-to-day basis. But these ETFs are really just tracking futures contracts. And so I don't want to get too sort of off the rails here, but it's sort of the same concept. If, when you enter into any investment, understanding how it's constructed will go a long ways to setting proper expectations, which, as we always say, is the key to sort of any investing there.
Yeah. So you're saying you should know what you own?
something like that.
Hmm.
I remember reading a piece about that somewhere.
I think I recall
Yeah.
a certain company that wrote something about that or talked about that. All right, so let's dive in with a little bit deeper then, and let's look at some actual examples. So you've got a couple, I've got a couple. So let's talk about that.
Well, let's take the two uh, market cap weighted indices that we like the most or follow the most. S&P 500 is the one that you're going to hear and read about the most. Uh, Currently, 50% of the index is dominated by 5 companies. And Christopher, when you do the editing, please full screen this picture because I think it's definitely worth 1,000 words or 505 companies, better yet. And essentially, you'll see how much it's skewed. And so, what are we talking about here? I think it's Microsoft, Facebook, Apple, Amazon, and Google. That together make up 50% of the index. So anytime you're reporting on what the S&P 500 is doing, you're reporting about what those 5 stocks are doing plus the other 500. Long story short, there's 505 because of some share classes and stuff, 505 stocks in the S&P 500. And so, I had a conversation with someone the other day about this, and they're like, well, that's not a broad-based index, use something else. And I said, fine. Well, the Russell 3000, is that broad enough for you? Sure. Well, okay. Well, so the top 50% of that index is made up by the top 50 stocks. And so you're talking about 50 out of 3,000 that make up 50% of the index. So once again, and these are not just tech stocks when you talk about the Russell 3000, Johnson & Johnson, Visa, MasterCard, Procter & Gamble. It's just the rich are getting richer across the board in the stock market. And you can see that with any market cap weighted index.
Right. Yeah. So the S&P, you're talking about 10% equates for about 10% is what's driving that, and the Russell's what 16-17% something.
Yeah.
The top 50 out of 3,000.
Yeah.
I mean it's pretty crazy when you think about it, right? I mean, if you don't understand that concept, then you don't realize what an effect 1 or 2, or in this case maybe 10 or 15 can have on your overall return. I've got a couple of more specifics in this process, and we've got an image for those that are going to watch that will I think will also speak volumes. But if you were to just ask an advisor and say, look, if you could put the big 3 car companies, right? GM, Ford, and Chrysler, the big 3 American companies. Add companies like Honda, Mercedes-Benz, Harley-Davidson, which is a motor company. It's just on 2 wheels instead of 4. If you could put all those together, right, what would that be in a market cap? Well, recently we looked, and that's about 147 billion. There is one car company that equates to more than that, and it's Tesla. $148 billion. So, on any given day, obviously that's close enough that could change a little bit. But the reality is, when you look at revenue, those first 6, $775 million in revenue, or excuse me, $755 billion in revenue, how to get my numbers right, versus Tesla at only 25. Not only that, I mean, you got Tesla. Let's talk about the dichotomy. The absolute, people either love Elon or hate him, love the car company or hate it. But that actually would fall about number 32 or number 33 on the S&P 500, and they've been trying and getting closer to getting into that list, right? So I mean, somebody else would get kicked out potentially, but that's been the word on the street for the last couple of months: is will Tesla get in? And there you go. There's one of those top companies that love it or hate it, that's going to have an impact on the S&P.
Yeah, and then you had a more. I like, after reading your notes, the second example, just because it hits home to everyone working from home.
Absolutely. So 2 other companies that are already in the S&P 500: Netflix and Disney. Netflix is now larger by market cap than Disney, and of course that we looked at this. This is sort of mid-March. That was the case. I think it's actually flipped back.
Just asterisk, subject to change. Yeah.
Yeah, absolutely. Subject to change, right? We all know we're in this business on a daily basis. That'll change a little bit. But think about the perspective of one streaming service. Yes, they create some of their own content, but primarily it's a streaming service for video content for all the people that are stuck at home. The other are Disney parks globally, right? They've got Disney movies. They've got Disney Plus, their streaming service. They own ESPN and ESPN Plus. All of those things together don't equate to just this one little streaming service that only started, what, 10, 12 years ago, something like that? Kick Blockbuster out of business.
Yeah,
I mean, pretty crazy when you think about it.
It's and it just speaks to sort of what's going on with the valuations in general. Now, we're not here to say something's overvalued or undervalued. It's just the simple fact that what constitutes the index, and some of the sort of eye-popping stats that are out there among these individual companies.
Well, and likewise, for additional clarity, you're talking about basically, Disney right now is number 20, and Netflix is, this is, again, just a ballpark, subject to change on a daily basis, number 27 on the S&P list, based on market cap. So, again, these are companies, part of the reason we're bringing them to the forefront, these are companies that are in that, top 20, top 30 kind of space that have an impact. They're not the big five, but clearly are worthy to have a conversation about. So what other thoughts do you have on the market cap indexing process itself?
Not really. I mean, I just think that, if you look back, we're at the highest levels of concentrations since the 70s. And I think back then it was IBM that dominated it. So it's not unheard of to have this much concentration. But it's something to keep in mind, as the market evolves, and as maybe advisors are willing to add more to certain index-based funds. Just keep in mind sort of what your comfort level is, because the drawdown on these large caps can't, especially large cap techs, can be brutal. And so in this recent decline, they held up really well, which is why the S&P came roaring back, because of the performance of those five. May or may not always be the case. So, once again, just make sure you understand the drawdown of those five, because they make up 50% of the S&P. So that's going to be your drawdown if you're in that index fund.
Yeah, and if advisors don't have access to those numbers and would like to know on one of those companies what the maximum drawdown is, well, give me a call. Reach out. We'll be glad to chat with you. Again, we're not individual security experts, but again, it's food for thought. And my takeaway would be, as we mentioned before, know what you own. Period. You got to understand what it is that you're using to invest for your clients. Just because, again, that if you don't know what you own, how can you have a real expectation of what that experience is going to be like? So,
I do have one more thing to add before we sort of move on. Historically, it's, at least for me growing up in this practice, in this business, the S&P 500 has always been sort of the benchmark of choice, right? You have, it has a longer history than most indices. It's been around for a long time. So a lot of time, funds or SMAs, UMAs, they just attach the S&P 500 and move along. And I've always felt that it's an unbelievably horrible benchmark. And I think that the concentration that's going on today, in a way, proves my point. Because if you have a client account that is diversified with different managers, international bonds, whatever it may be, and for some reason your system decides to attach the S&P as the index, your clients don't own 50% of those five tech stocks. And it's just, I think it's a huge disservice. And we did a podcast about this, and the title was, it was going on with during the trade war, benchmarks are more dangerous than trade wars. And once again, I think for investors, benchmarks are one of the most dangerous things, whether you're chasing it, whether it's setting bad expectations, and just the mental, mind fuck it plays on people. It's just not. You need to find benchmarks that are closer to what you need to retire. We can get into a whole diatribe about that, but to me, the bottom line is these concentrated benchmarks or indices are horrendous benchmarks.
Yeah. Well, and like I said, it's great when you happen to have them all be tech stocks, and tech is what's really kind of driving right now. But what happens when it's not tech stocks that are driving, and those are the top five? Right? I mean, you're cruising for a bruising.
Just
so
know what you own. So what do you got? What are you recommending this week?
All right. So what I'm recommending is a show on Netflix, a series called The Last Kingdom. My son he's the one that gave me the recommendation for the Peaky Blinders, which I recently talked about. So this is something set back in the period of, I wouldn't say Lord of the Rings kind of feel, but right, it's back in England, Ireland, when the Vikings were attacking, trying to take over the entire area, and basically you have a king that who would have been king as a child was actually taken by the Vikings and raised as a slave, but became a son, right? Then turns around and comes back to England to try and save the whole area. It's just a cool concept. Love this kind of period piece. It's not a documentary; it is fiction. But yeah, it's kind of cool. They just came out with the 4th season, so you got a fair amount of shows if you want to dig in on this one and enjoy something that is just completely away from our current life that we live today.
Hard no for me on any Viking historical shows, but to each their own. So,
well, hey man, I jump in on these partially because even though they're fiction, it helps it sounds funny. It helps give me a good reminder that I am really glad that I have running water, toilets, and all the toilet paper I can use. I mean, I've got a pantry with food in it. I don't have to go out and kill what I'm going to eat tonight. When it's all said and done, we got it made.
Fair enough. All right, well, look, my recommendation this week is a company called Cameron's Seafood. I grew up in Maryland, born and raised. We used to go to Cameron's all the time to get crabs, and what they have done is amazing. They were a local crab shop. Now they ship across the country, whether it's blue crabs or crab cakes, crab soup, whatever. They put it on ice, the crabs, they cook it, put it on ice, throw it in the oven, 15 minutes later. It's wonderful, and we had some a couple weeks ago. Order some more again. Just making the quarantine work.
You and your crabs, man. I just can't do it. I just can't do it. Well, I'm glad it works for you. At least you can get a little something from your good old Maryland.
You can order some Omaha steaks and knock yourself out, right?
Damn straight. I can get cow just about anywhere. All right, on that note, certainly if you have any thoughts, questions, etc., reach out to us. You can go to the www.potomacfund.com to our Connect Us page. Thank you for listening, watching, and subscribing. All right, we'll talk to you later. Peace out.
Later.